You can own less than 100% of a business and still have to combine its entire financials with yours. Other times, you can own a big stake and not have to combine anything at all. So what actually decides it? In this lesson, I'll show you how IFRS 10 defines control, and how you actually combine two sets of books into one. A while back, our founder wanted to secure her own coffee supply, so she set up a small roastery, Breezer Roast, alongside her cafes. She invited her friend Nadia to invest, and put in the rest herself. Founder ended up holding 80% of Breezer Roast. Nadia holds the remaining 20%. Founder makes the day-to-day calls, which beans to buy, how to price the roast, who runs the equipment. Nadia's an investor here, not involved in running it. Now it's year-end, and our founder needs to put together financial statements, not just for her cafes, but for the whole group. Question is, does Breezer Roast get folded into her financials, or does it stay separate, since Nadia owns a slice of it too? That's exactly what IFRS 10 answers. Let's break it down. IFRS 10 says you consolidate when you control another entity. Control has three parts: power over its key decisions, exposure to its returns, and the ability to use that power to actually affect those returns. For Breezer Roast, our founder ticks all three. Her 80% gives her voting power to direct the roastery's key activities. She's exposed to 80% of its profits and losses, and she actively uses that power, deciding suppliers, pricing, staffing. So Breezer Roast is controlled, which means, under IFRS 10, it has to be consolidated into the group accounts, even though Nadia still owns her 20%. Why bother combining them? Because to investors and lenders, the cafe chain and the roastery aren't really separate businesses. Together, under one controlling owner, they are a single economic group. Consolidated financial statements present that whole group as if it were one company. Every asset it controls, every liability it owes, all in a single report. Here's how it actually works. You don't just add 80% of Breezer Roast's numbers, you add 100% of everything. All its revenue, all its expenses, all its assets and liabilities, line by line into the group accounts. That might feel odd, since Nadia owns a fifth of it. But you consolidate 100% of the entity first. Her share gets accounted for separately, afterward. Once everything is combined, you strip out anything that's really just the group trading with itself. Say the cafes buy their roasted beans from Breezer Roast. Inside the combined figures, that shows up as revenue for the roastery and an expense for the cafes, but it's really just money moving within the same group. IFRS 10 says, eliminate it. Cancel out that intragroup revenue and expense, and any unsold inventory still marked up from the internal sale, so the group's numbers only reflect deals with the outside world. Last piece, Nadia's 20% doesn't just disappear. Her share sits in the group's equity, as a separate line called non-controlling interest, NCI for short. And each year, Nadia's 20% share of Breezer Roast's profit gets carved out too, so the group's profit statement shows exactly how much belongs to the parent, and how much belongs to NCI. If this cleared things up, the full Breezer Console Academy course goes much deeper. Loss of control, potential voting rights, structured entities, and how Breezer Console automates the entire consolidation process. Links in the description. And if you're consolidating a real group, not just cafes and a roastery, Breezer Console is built to handle exactly this. The control assessment, line-by-line consolidation, eliminations, and NCI, all in one platform. Come see it at breezerconsole.com. Thanks for watching. See you in the next lesson.